Thank you all for attending this special webinar. This is going to be my last special webinar before Christmas. There will be a couple more that will follow in January next year. The inspiration for this webinar is actually pretty simple. If you've ever traded or spoken with anyone that's traded for an institution, like a bank, hedge fund, even a prop house where there's other traders there, one of the things that you'll know is that there isn't one way to trade. My experience obviously comes from prop trading, and I found the styles of trading were hugely varied. There were guys there that traded news. There were others that didn't believe in trading news. There were some guys there that used charts. There were others that really only glanced at the charts and leaned very heavily on the order book. There was even one guy there that ran a system, but most of the people there used experience and instinct. A lot of people use levels. Some people I know used indicators. Really varies. And essentially the one thing that you do realise when you're around other professionals is that there isn't a right and wrong way to trade. There are so many different ways to trade effectively. And with that in mind, what I've wanted to do for some time now is invite in another professional to give you another perspective on profitable trading and to talk with you guys. And I'm really excited to have Piers Bullock in. Piers is currently a prop trader and head of training for Pine, which is a city-based prop firm. And he's been trading for 9 years. I actually met Piers about 5 years ago when we were both trading prop. Piers trades a variety of markets, including foreign exchange, fixed income, equity markets and energy markets. And I think what gives Piers a really unique insight into trading is that he's trained up traders at 3 different prop firms. So he knows a lot better than most what it takes to make it in this game. So without further ado, I'm going to pass you over to Piers.
Okay guys, it looks like we go. As Tom said, my name's Piers. I traded a variety of asset classes, different products, and I met Tom a number of years ago. We were both trading at the same prop shop. Just to start off, I'm going to talk to you for about 45 minutes, and then we'll have time for some Q&A. Trader personality, one of the first things. New traders often pick inappropriate markets. I'm going to talk about some of the reasons why, and also this is really a case of trader experience with market personality as well. And I'll show you some of the markets I've recorded just to illustrate the ways they move differently, and this will hopefully bring it to life. We'll also look at trader attitude as well. So you probably find in a number of areas of life outside trading, you'll be speaking to people and you can tell by something they've said that they have less experience than you, less knowledge in this area, and the way they voice their opinions. And I'm just going to talk about this kind of thing with respect to trading. We're also going to look a little bit at trading psychology. So I summed it up here with revenge as a dish best served by somebody else. And this is really talking about some of the traps we can get into, the way the market can take on a personality. You can want to get your money back in the same market or through the same style of trading or in the same move of the market. You can end up losing a lot of money very quickly when things go out of control. And also look at planning your day as well. So daily routines, weekly routines, monthly routines. How you can anticipate when there is going to be market volatility, sufficient volume to trade in the style that is appropriate, how to be aware of what's hot at the moment, what current news will move the markets. And I'll show you again a little bit of research that perhaps will give you an idea of how you could structure your own days or where you could perhaps go to find information. Before we get started though, I'd just like to tell you a bit about prop trading, so the style of trading that we do, and hopefully this will allow you to filter what I'm saying and put it into context. So we work in the city at a prop trading house. There's a number of traders here. We all trade intraday quite frequently, quite high volume. And it's not the only way to trade, but the necessities of what we do almost enforces a certain style of trading. So you'll find that people trade fairly high frequency with fairly large volume, and this means that they get far more opportunities on a daily basis than my longer term swing traders or people that buy and hold. This allows our edge, our technique to work statistically, to come to bear upon the markets more frequently. The thing is that most prop traders have high costs in terms of IT and data services, office space, so you need to make money on a monthly basis. And so really, a lot of guys will approach it in a bread and butter way. You're not looking to max anything out at any one time, although if it comes along it's nice. But what you are looking is to be consistent, to make constant daily money. And this also reflects in the psychology bit as well. So you'll find some of the guys that have been here the longest are actually the most level-headed. They don't go chasing moves. They know that there's another one along soon. They live to fight another day. And again, we'll touch on that too. To give you a quick insight though, that is a picture of the trading floor at work. You can see you've got a lot of guys sitting around in fairly close proximity, a lot of screens all over the place, and there's a lot of camaraderie. You will often get guys trading similar products sitting quite close to each other. So that means there's a lot of sharing of information, and it happens on a real-time basis as well. There are speakers in the ceiling, squawks, giving live analyst updates constantly. When the market's quiet, people are probably just talking about football, other banter. When it's busy, there can be screaming, shouting, lots of market chat. It's also useful because you've got all this pooled experience in the same place. So, for example, the guy on my left here with no hair, he trades interest rate products, and he's been doing it for a long time. So, sitting on his right, I was trading oil there. I'm not necessarily concerned with what the interest rates are doing, but every now and then it might be an issue. And I know that if he says something, I should listen. It could be that he articulates it and says something meaningful, or it could just be that he starts swearing a lot, and I know that he's been caught. And from that, I might guess what's happening. Equally, the other side of the desk, there's guys trading equities. So when they start making a fuss, you can infer that something's happening there. And it's a far cry from the pits, the type of trading that happened there. But again, noise, excitement levels were an issue there that allowed you to read the markets. So even though we don't have that for us as futures trading locals, there's still an element of it in the office setup. And this is just a close-up example of a desk. So you can see here, the bottom 4 screens are all trading screens. Each of these ladders, so to speak, each of the vertical arrangements with the red and blue. These are each individual markets. The bottom 4 screens are all trading. The top left, that is forward curve data that's been put into Excel. The second screen over, that's on market profile and CPG. Third screen over, that's economic news and events. And fourth screen over on the right, economic news and updates. And if you look at the yellow figures at the bottom of that Reuters screen, it will look like this. So you can see, for example, here you've got real-time breaking news scrolling down as it happens in white boxes at the top. You can highlight keywords, ECB, Federal Reserve, whatever you want, whatever you're watching. And at the bottom, you will get economic data literally seconds after it's released. And just one further pick of a desk setup. Something that comes up when you're interviewing people who are trading on a retail basis. Something that comes up when people first come into trading and you ask them, or they make clear, which way they'd like to direct their trading, which they'd like to look at. Experienced guys will often tell you that frisky markets with high volatility that make the headlines because of that, it doesn't really equate to profit potential. What it really equates to is risk. If you do have very volatile products like the oil, which can move hundreds of ticks in a day, you could lose a lot of money very quickly. Professional oil guys and energy guys would not trade an outright oil contract. So you would not trade the front month naked or outright. What you would do is spread it against the next month, or maybe put it into a multi-leg spread, such as a butterfly or a condor, or some other form of spread, such as a box. And this would make it a lot more stable and give you a chance to react, a chance to think. With that in mind, I'm going to show you a few recordings I've made of live markets that will illustrate this. Okay, so what we have here is a setup of interest rate products. These are Euribor contracts. That's European Interbank Offered Rate. So this is essentially 3-month money, the cost of 3-month money for when very stable financial institutions are borrowing. And you can see in the top left, that is December 13. So that is the current front month for interest rate trading. And we go along with March, June, September. So each of these represent those delivery months for 3-month money, going out all the way to September 16. So I'm talking now, but you should be able to see a little bit of movement, a little bit of sporadic movement on some of these markets. I mean, you notice there is movement, but that it's controlled, or that you can keep abreast of what's happening. It's not happening too fast to keep track of. So a lot of guys trade these markets. The contract is Euribor, when people first start trading, it often gets referred to as Uri boring. It can move very slowly. Periods of time, it can do nothing at all. And for this reason, new traders, younger traders, often are put off this product. When you start with small size, it can take a long time to get filled. The contract in the top left, the red figure on the offer, you can see there's 86,400 lots there. Below on the bid, 86,400 lots there. So it can take a long time to get filled here. With small size, you might just make tens of euros on a daily basis. It doesn't feel as though there's a possibility to make lots of money because they move so slowly. In actual fact, once you get proficient, this depth of market would allow you to trade enormous size. So a starting guy might trade 1 lot here. We've got a guy in the office that will trade this in 5,000 lots or more. And you imagine you don't need a big move with 5,000 lots to make a serious amount of money. I mean, 5 figures, 6 figures on a daily basis. But you need to start slowly. Let me show you some other examples. This is an equity market setup from the morning. So you can see there's a bit more movement than the Euribor, but because it's a quiet morning, there's not that much happening. Looking from the left here, this is the S&P, this is the Euro Stocks, this is the DAX, the German blue chip index, and FTSE UK index, and on the right here we have oil, just for contrast. The buy orders on the left side here in the blue, and same here in the blue. On the right hand side, all these red numbers are all offers. So you can see as we start on the left with the S&P, 1,000 lots on the bid, 1,000 lots on the offer, relatively stable. This is actually quite light because it's the European session, the morning session, not the US session yet. If we look here, the next one, you can see the Euro Stocks. So again, quite liquid, quite a lot of size here. And you notice as well the range smaller. The higher the day is here, the lower the day is here. If you look at the DAX here, which is quite a volatile market, you can see we're off the screen at the top and the bottom. The daily range has already exceeded that. And again, the order numbers are quite light, so you can see how it could move quite quickly. This means that if you did have size on and the market got away from you, you could get a lot of slippage getting out, you might not be able to react quick enough, you could lose a lot of money very quickly. Whereas the Euro Stocks would give you more time to think. Not always, it can still move fast, but you'd have a bit more of an advantage. You might not be the last person to get out of that price before the market disappears. And again, the FTSE here, again, quite a thin market. And these are bond markets. So again, you can see on the left, we have a very thick market. These are 2-year bonds. Here, we have 5-year bonds. Here, we have 10-year bonds. So these are all European, German, to be precise, German bonds. Here, we have UK bonds, 10-year. And here, we have American bonds, 10-year. So you can see a lot more liquidity in the short end than in the long end. And for that reason, you could do a lot more size here. But we've had new guys start. They'll want to trade these products, the longer end products, because they're thinner, they move around a bit more. The perception is that you can make more money and get better moves, but also it allows you to bring technical analysis to bear. And this is something that people learn on a retail level before they perhaps become professionals or become day traders. And by looking at the market in those terms, classic chart patterns like head and shoulders, supporting resistance, things such as that, and also using technical indicators, you can analyze a long-term market like that has moves. If you look at a chart for a product like the Schatz, this 2-year bond, it's just a series of flat candles really. It doesn't really show anything, especially on a short-term basis. It's very hard to analyze. So really, you need to make market decisions from staring at the order depth such as this. And this is very alien to a lot of people. So perversely, those that have actually had the enthusiasm and energy to teach themselves, to learn about technical analysis, to spend time in front of the markets, to spread bet on their own, in actual fact, they sometimes have lessons to unlearn or need to reevaluate their approach to trading. Because although valid, there might be more profit opportunities in a shorter end product, in a slower end product. These are the equities in the afternoon. You can see the DAX here is really starting to heat up. And the problem is that if you're new to trading and you are hesitant and uncertain, it can move quickly, more quickly than your decision process can operate at. So you're wondering, do I need to get out? Do I not? Next thing you know, you've lost a lot more money than you intended. maybe then it comes all the way back and it's faked you out. They take time to get used to, and they can provide good profit, but they're not really an area for, I guess, the novice trader to enter. You should see the cash open for the S&P happen in just a moment, and there should be some activity in this contract when it happens. There we go, it's just started now. You can see how suddenly a lot more volume has come in. So again, is it going up? Is it going down? If you had a position on, you were relatively new, you would be caught in the headlights a little bit. Again, just to talk about the same thing from a different perspective, if we look at a chart, it's possible to see the same thing. So on the top here, we have the Euro Stocks, we have the DAX, so both equity products, both European, but this illustrates a little bit how the DAX can overextend and show increased volatility. So for example, here, the stocks has peaked, the DAX a lot further. If we look at it compared to here, stocks has just poked through a little bit, DAX a lot more. If you were trying to use that as a stop level, it would almost certainly catch you out. Again, you can see here on the stocks, this is quite a stable low. If you were to be placing stops plus support, you might get caught there, depends on your stop placement. With the DAX though, you could get caught repeatedly and still not be wrong. The market still goes up, but you've lost money several times here. So again, here we have the German 10-year bond, and on the bottom we have the Schatz 2-year bond. And again, we're looking at these on 15-minute charts, so not a massive time frame, but you can see here how stable this product is, and also how hard it might be to analyze from a classical technical analysis perspective. You don't have the same formations and patterns and setups that you might on something like this. And you can just see in the candle shapes on these two. But again, here, this has been relatively restrained. Bund pops up, Schatz hasn't moved up here, but Bund managed to poke up through these highs. These aren't necessarily bad things, they're just characteristics of a market. Different markets have different personalities. They require getting used to, but for overly frisky and overly erratic and overly illiquid markets can present added danger. The question just came up there saying, do a majority of traders at our firm trade the same markets? I would say not. I'll perhaps answer that a bit more fully at the end. But there is a reason that lots of traders like to trade the same markets, and that's because there's added liquidity there. And this means you can have better execution, you're not going to have so much slippage, but also those markets are a lot more stable. And there's another reason in terms of market choice as well. If you trade something too esoteric, you might be out of the information loop. So for example, if you trade energy, metals, or agricultural products, you can be well behind the loop in terms of what information there is. Whereas if you trade FX products, fixed income bond products, or equity markets, especially European G7 Western equity markets, you're going to have access to the same information that bank traders will have, that other people have. You're going to be up there on the news flow. Okay, we'll just move on quickly. Talking a bit about trader attitude and how experience shows. So one of the things that prop traders will do when they trade on a daily basis is focus on the same market. What it really means is that you're becoming familiar with that market and sensitive to it. You know its foibles, you know how it trades in the morning, you know how it trades when the US opens, you know how it trades in the afternoon, you know how it trades in the summer months when things are quiet, you know how it trades coming up to Christmas when people start to liquidate their positions. This means you're more sensitive to see changes in what is happening. Is the market going for a big turn? Are the effects of economic data slowly starting to be felt? Is more liquidity coming back in? Is it becoming thinner? Have new algorithms entered? Is there a flipper doing things at a certain time of day that you can be wary of, possibly even take advantage and make money from? If you don't watch the same markets every day, these are things you miss out on. I mean, very often people start and they'll trade cash stocks, cash equities, and this is nice because there's variety, but there can be a bewildering amount of information. Not that this is a bad thing, but it means you're spreading yourself too thinly and becoming perhaps a jack of all trades rather than master of a few. And you'll notice even people that do day trade cash equities intraday, they tend to focus on a few stocks. So for example, previously it might have been Google and Amazon, things that you can look for on a daily basis, trends to trade. I would also say with regards to trader attitude and experience, it's the same with the technical tools. So whilst focusing on the one market or group of markets, you'd also focus on the same number of technical tools. So you wouldn't change from Bollingers to Fibs to MACDs to stochastics every day. In fact, you might not even use any of them. But if you were to do so, you would use one, perhaps two, and get to know them as well, really well, because they would have a personality, especially in conjunction with your market. So, for example, I know a guy that trades buns, and he uses stochastics. And that's not my cup of tea, that's not my flavour of trading, but he watches them all the time, and he's very sensitive, and he can see things in them that I can't. I'd also say, with regards to experience and the attitude, guys that have been here a while tend to have a lot of patience. They know that blowing your cool, you can do a lot of damage quite quickly. I mean, hopefully not something you necessarily have to experience, but it's possible to lose a month's money in a day, and that can feel quite physical, almost like you've been socked in the gut. It really takes you back, and then that makes things bad for the next week. You come to try and trade again the next day, and that's staying with you. So in some ways, it's being kind to yourself. You have to learn to manage yourself in those ways. Again, when it comes to attitude, it's about taking stops or discipline. You know that if you're hoping the position comes back, you're probably onto something wrong here. But it also means you're looking at periods of extreme volatility. So Federal Reserve, the FOMC meetings, 10 of those a year. The next one will be 17th, 18th of December. So we might find out about future tapering there. A lot more people finish their careers by getting involved in such events than start their careers or give their careers a boost. I remember during the times of the credit crunch, younger traders would come in asking for extra limits, wanting to be there all day, nail a move as soon as something was said. This is bad for a few reasons. A, it means they're jumpy and itchy trigger fingers, and they could click at the wrong time. They could get it wrong, just being caught up in the excitement. But also, they're not forgiving. If you do get it wrong, that single mouse click could end your career, especially if you're starting and you don't have a big account. I mean, experienced guys I know will just go home. They won't hang around for FOMC. When the market's too volatile, they'll just sit back. They might not even trade ECB, even though some traders love that. In some ways, it's about knowing what works for you when the markets are stable. There aren't going to be surprises there, and just putting that to work over the long term. That's not to mean that it's mundane or boring, just that you can have confidence and faith in yourself. And I guess I'm working in an office with traders who are 30 plus, coming up to 40, wives, children. So a lot of them are looking to treat it as a job and a career, not as something to get thrills from. Okay, we're coming up to revenge as well. This is something that I was talking about with a mate the other day, actually. And I see it in the office when I'm watching the risk, and I can see some of the trainees getting into sticky situations. You have Messenger or Skype and then talk to them or go and talk to them in person. The thing that triggered this particular title, the revenge aspect, is how you can get fixated on a certain market. So it might be that you've lost money in the DAX and you feel it was unfair for some reason, perhaps because the market hit a stop, spiked down, took you out, and then continued. But you feel as though your money was taken from you unfairly. You want to get it back, but not just in any market. No, you have to get it back in the DAX. Maybe you lose more money again. It could just be the wrong market for you. You need to let it go. Linked to this is persisting in trying to trade a move that's not working for you. So again, I was with this friend the other day. He was trading the DAX. A lot of bad stories are actually associated with the DAX. He tried to buy it. It was a good place. He put a stop in. Next thing you know, it had been stopped out. I thought easy come, easy go. The DAX is like that. Next thing you know, he was long again. He just bought it again, another stop. 10 minutes later, stopped out again. He did this 4 or 5 times. He lost a chunk of money that he shouldn't even have had in play. Silly mistake, a rookie mistake. Thing is, these mistakes can be waiting for you no matter how experienced you think you are. You shouldn't become complacent. It's almost akin to moving your stop, really. And again, this can come from having your stop too tight in the first place. So you need to consider your trade, put it on. If you get stopped out, it doesn't work, that's fair enough. Don't compound the situation by making the same mistake again. Another aspect of doing this is wanting your money back, but wanting it back now. You've just been caught on a move and then instantly get back in the market, and literally within seconds you'll see another position flash up. It could be the same one, or often the other way. They've just been caught long, they got stopped out, they've gone short. Next thing you know, they've been caught on that position. And the way I'd like to describe it is it's as if somebody's drowning in the market. They're flailing around, taking positions far too frequently, far too quickly, taking stops, When they are inside, they're not taking the profit because they get it all back on one trade. Next thing you know, they've lost money on that, and it's very much the sign of a downward spiral. It can happen quite quickly. You can give back your day very, very quickly. There is a book that talks about a number of these things, and the way that it sums it up is to say that a trader should always act in his own best interest. And that phrase really sums it up. If you take a step back and think about it in terms of longevity and where you want your career to go and how you perform for the week or month, or how much damage this form of market activity could do, it's a good way to look at it. Act in your own best interest. And the book this is taken from is Emotion-Free Trading by Larry Levin. Might not be for everybody's cup of tea, but there's a lot of common sense in there as well. And that's the thing about a lot of this trading approach, is a lot of it is quite commonsensical. Easy to forget, but when you're talking to graduates and trainees, because sometimes it doesn't cross as sufficiently complicated, it can get disregarded. But then again, you'll find that different people have different personality types, and they tend to make the same mistakes as well. We had a new guy who wanted to trade the S&P, Italian guy, quite hot-blooded. Red mist comes down as soon as something doesn't go his way, and he just goes crazy. So again, we had to put him in the 2-year product, which moves very slowly, and he still manages to overtrade that, but he's certainly making headway and is seeming to make good profit. Just in light of this, I'd like to show you a couple of trader records actually that speak to me. I can see the trader traits being shown in them. The blue lines here mean simulator trading. The black lines represent live trading, and obviously if the line goes up, that's a profitable day. If it goes down, it's a negative day, and these are denominated in ticks. So that's 51 ticks up, that's 30 ticks down, lost 30 ticks for the day. The bit I'm really looking at here is this consistency. There was one down day here, not too bad. I was very pleased to see him come in the next day and have an up day. And it didn't need to be a big up day, just small up was okay, but it was just a case of getting back on the horse and being in profit. And you can see there's another good winning streak here. Made money, made money, made money. Down day here, small up day, but this is the bit really. For one reason or another, it could be that it was a good run here and the trader became complacent. It could be that they had a good run and they were expecting something to go wrong, but we had down day, down day, down day. Again, there's another example of it here, and this was a particularly bad one. So yeah, I think down day, down day, down day. And again, this was a chance to go back on the sim. But this is one reason why experienced guys sometimes will not trade to their stop. If you've got a certain amount of money you can lose on a day, it doesn't mean you have to lose it. If the market's just not going your way, or you're not feeling it, or you're calling it wrong, stop early, stop in the afternoon, go home, or just sit and watch the screens, or cut your size. But don't try and max it out or push it or recoup it. Some days you just not got it, and other days you have. Some days it's like candy from a baby, other days it's just that you've never traded before. When I spoke in terms of market personality as well, you very much get in sync with the market moving in a certain period of time, and this means that you can sometimes almost trade it automatically. But another reason to go with thick liquid markets is that if a few participants change their activity, it doesn't mess up the whole market. If a thin market has a few guys that start to bully it or stop trading, it can massively affect the personality of the market, because there's a lot of volume that contributed to that market microstructure movement that is now not there or not present. And some guys have been trading for years. I mean, 18 years I've known guys trading certain equity products, making money nearly every day, almost like a machine. Something changes with their market, not much, but that's it. That's game over, career over. They have no edge. They don't even recognize the market anymore. So another good reason for thick liquid markets. Here's another trader's records. Again, you can see the lifetime here and here, but very erratic. Up days, down days, up days, down days. There was no real pattern of consistency. We had a good run here, but again, we had a negative run here. So I guess this implied a certain amount of frantic activity or pushing. This guy was up against it. He was struggling for money. He did need to make it work, and I guess that could be apparent in the results. This is another common thing we see. As you can see on this guy did very well, made lots of money. When he went live, put the fear of God into him. You can see, he's up 100 ticks here on the sim. He made 4 ticks live. I guess first going live, that's understandable. And this is also a common thing. People will grab their profit when they have a small profit, but then when they go down, they'll just keep pushing it to recoup it. Again, I mean, look at this. 0 ticks, 0 ticks. I mean, some guys traded, perhaps once or twice a day, whereas on the sim, they would just go crazy. They're all over it. And this guy obviously had something. I mean, it is possible to game the simulator, but I know that this was good trading. You can see he's come back on the sim again here. I think we probably talked to him and asked him to treat it as live and to be really on it, whereas here we would have been quite carefree. And you can see there's a bit of an improvement when he's gone back live again. This is a very good trader. The thing is here, when he had some down days, he didn't go to his stop. His stop would have been about 50 ticks, so nearly there. He stopped early, stopped early, stopped early, stopped early, stopped early, stopped early. This guy was generally a quite happy guy, I think, and didn't have the money pressures. Really nice bloke, but you can see when he was up, he pushed it. So his up days were all bigger than his down days. I mean, look at this. He made 240 ticks there. Far exceeds his worst down day, which is only 62 ticks. So just a case of control. And I think as well, he obviously was in sync with the market, because you can see he did make it look effortless. And I'll quickly talk to you as well about market activity as well, and you'll perhaps understand why some guys can get this. We have some equities guys, they'll come in, they'll trade the open, they'll trade AM figures, and they'll take it easy over lunchtime, they'll trade the US Open, then take it easy mid-afternoon, maybe trade the close. But there's certain periods of the day they look at where they've got an edge, they recognize it, and they'll take advantage. Just one last chart. This was an exceptional trader. Just look at the amount of consistency. I mean, the down days were so infrequent. Again, it could be a bit larger, but yeah, this trader was really very promising. Okay, in terms of planning the day, the week, the month, I've got a few slides to show you. All of these things are subjects for 45-minute lectures, classroom discussions in their own right. And I would say that this one is one of the most important. And when I'm training guys, this is one of the things that they might not think is key. Planning your day is super important, more important than even technical analysis ability or reading the market, I would say, because you need to act appropriately. So, for example, if you're coming in to plan your day, you would need to be in the office at 6:30. I'm just going to put up something in a minute, guys. So before I'm coming in at 6:30, I would check out some overnight news. When I'm training guys, I'll make them do 2 hours of prep every morning in order to understand what's important. So we start 2 hours, it becomes an hour and a half, an hour, 30 minutes, and always I'm pushing them to get faster and faster. And a key part of this is taking all this information, there is a lot of it, and being able to assimilate important, both to you, your market, and also with respect to what's currently hot economically. So for example, at the moment, employment is very important. In the UK, Carney has talked about the 7% unemployment target. Until that's hit, rates won't rise. In the US, the Fed is always talking about tapering and tightening of monetary policy with regards to the employment figures at the moment. So these are very topical. With the credit crunch on, it was the housing numbers. So again, you need to be very alert for developments in key pertinent factors of the moment. So you can see example here, this is overnight news. I'd skip through this when I'm coming in. This is just the tip of the iceberg. There'll be other market recaps here to see what the Asian sessions have done overnight. These are emails, things I get emailed by Squawk services, by research people, from friends at banks, from funds, from brokers, all kinds of things. So the thing is, you can get swamped in this information if you go looking for it. There are all kinds of ways to get it, but you just need to be able to sort it. And unless you skim through it in an appropriate way, I guess it's wasted. Again, before the market opens, you should look at the daily calendar. So this is an economic calendar from ITC, Broker Talk, whom we use. So not only would I be looking at data, so you can see here we've got UK figures at 9:30, industrial production, manufacturing production, these would move the market, trade balance is irrelevant, GDP for Italy would be irrelevant, no figures in the US at this time of day. So again, I'd envisage here that European markets would have a relatively quiet morning. UK's would be quiet 9 to 9:30 preceding this. People wouldn't take positions. On the back of 9:30, things could happen. Maybe they could, maybe they couldn't. But on no account should I have a position in a UK or sterling product going into 9:30 because I could get caught very badly. So again, just an example of market awareness. And this is something perhaps that is drummed into you on a daily basis in a prop shop or a trading house, because you've got screens there in front of you saying it. You've got an analyst squawking it from the ceiling. Everyone else is talking of the same thing. But again, sometimes from a retail perspective, people don't always trade accordingly. They might not be aware of the implications necessarily, or even aware of what is happening. But market moves that people will search around for technical reasons can often be caused by these fundamental factors. So again, if I'm trading a fixed income product, I need to look at things like this. So ECB events, you see the MRO allotments. We've got bond auctions here. So again, Australian bond auctions, these could have an impact on the Bund, on the German markets. 6-month bills wouldn't be irrelevant. Again, we've got a 34-year gilt linker here. Because it's a linker, it wouldn't be relevant. And in the afternoon, equally, there could be corporate pricings which would affect the price of the bonds as people push them up so that the corporate bonds are priced off the government bonds. So it's important to be aware of what's happening different times of the day. And this can change on a daily basis, but there are some things that hold true regardless of the day. So as I said, European derivative markets open at 7. The cash markets, the stock exchanges themselves, actually open at 8. So you'd envisage that 7 to 8 could be quite quiet, but it's an important part of the jigsaw, an important piece of the puzzle. Unless you're there to observe it, you might not necessarily understand what happened at 8 o'clock or onwards. Maybe there was a guy that took a big position early on, got caught, and now he's stopping out. All important information. Again, you have the AM session. You might expect markets to quieten down about 11 o'clock, 12 o'clock coming into lunch. Not always, but often you can gauge by events or also by market volatility. So if you're watching the level of order flow, you could see how active it is, how busy it is, if it's likely to be sustained. Again, quiet for lunch. In the PM session, you'd have bonds open in the Chicago trading pits at 1:20 UK time, 7:20 AM Chicago time. So that's when you might see some volatility coming to the bonds, led by the American notes, the T notes, the 10 years. US equities markets open at 2:30, so that's 09:30 New York time. And NYSE will open and Nasdaq opens, and so you'll see a lot of volatility suddenly coming to the equity markets, and that in turn will wake up UK markets, that will wake up European markets and the other equity indices. So again, not a time to have a position unless you're well on side or you know what you're doing. Coming into the afternoon, you generally have US figures at 1:30 and 3:30, periods of volatility then depending on the figure. And again, you'd have the UK and European cash equities close at 4:30. So that could be a period of volatility as brokers and hedge funds and systematic traders maybe make use of MOC orders, which is market on close. So there could be a signal from the daily candle or daily action, which means you take a position on the close ready for the next day. And the cash bond settlement is at 4:15 UK time as well. So less important, but it can still be a factor. I mean, some guys I know can make their entire day back if it's been a bad day by trading the last few minutes, literally, from 4:25 to 4:30. If there is a lot of volatility in the equities on the market on close orders, you can make a lot of money very quickly or save a very bad day very quickly. But again, a lot of risk, but it needs to be approached in a measured way. Also, talking in terms of the month, it's important to know the way the data comes. I showed you the economic calendar here, for example, but a lot of these have a month cycle. So, for example, here's Chicago PMI, and this is a precursor to the important ISM manufacturing numbers on the first day of the month. And then on the third day of the month, you have non-manufacturing ISM numbers, and these will move the markets. The first Friday of the month is always non-farm payrolls in the States. This moves the markets massively. And so again, you can anticipate periods of volatility by the data that will be released. And again, there will be a quiet period preceding the data because people don't necessarily want to take positions or enter the market before they know which way the market might trend or what might be happening with the economy at large. Again, other things to bear in mind. It's Christmas. This week past has been dead. Next week coming will be even quieter. I had a particularly bad Christmas trading in 2009. I got very badly caught on consecutive days. A little bit like those charts I showed you earlier, actually, with the multiple stop outs. But again, it's important not to push it when the market can be frisky like this. Not a time to trade large sides or really push it. Again, contract rollover, futures contracts, March, June, September, December expiry. When the contracts change, there'll be a swap over in volume. There can be anomalous moves. It's important to understand why that might be happening. Option expiry for equities. triple witching, quadruple witching, time of day of the option expiry. In the bonds, you might get month-end portfolio rebalancing as the maturity of bonds fall from a year to less than, and they get excluded from the portfolios. And equities at month-end. I think that's about it, really, guys. I've talked your ears off. If anything, to take away from this, I would say be aware of market choice. Better to focus on a few markets and get to know them well. For example, if you're going to trade FX, focus on a few pairs, keep abreast of that news. Focus on, I don't know, the yen, the cable, the euro. If you're going to trade equities, don't trade US equities and European and UK. Just focus on a certain area. And again, some of the supposedly sexy products, like FX products with a global appeal, can actually be extremely volatile. So, from my perspective, I wouldn't really seek to trade FX products. They can have nice trends when they get going. That might be one way to trade them. I wouldn't necessarily look to trade them from an overly technical point of view or with tight stops. Again, with terms of planning your day as well, I'd just be aware of the economic calendar if you're not already. If you have a look on our blog, at the bottom here, that'll give you an insight into some of the things we talk of with regards to the trainees when we get to them, and there's normally a bit of insight there. And you can see what it looks like there. Yes, we do use market profile. Different markets will lend themselves to the use of market profile and other charting. Traditionally, guys on very liquid short-end products really liked market profile. I showed you the Schatz chart earlier, and if you put it into a market profile, especially if you're doing Euribor and short-end bond spreads against each other, it makes a lot more sense in profile. And again, bond traders, all independent bond traders, love market profile. So if you want any more information on that, the best thing is the Mind Over Markets book by Dalton Jones and Dalton, which is a bit of a classic. Okay. Okay, this question, by my experience, what is the average time it takes a trader by his own to be profitable? What's the difference if he tries it in a prop environment? The prop environment does not guarantee success. I guess some guys are going to make it trading inside a prop environment or outside. Some people just have the personality types. People can be profitable straight away. The key, the real measure, I guess, is consistency in that profitability. So some guys that start profitable, the market situation will change and their profitability will take them for the worse as well, because they don't have a fullness of experience. They haven't seen an increase in interest rates coupled with a tightening of interest rates, a full monetary policy cycle. They perhaps haven't seen the zero interest rate policy we have at the moment, but then again, neither of any of us, I guess. So it's a very hard question to answer how long to be profitable. I would say that we've got these guys here 3-4 months down the line and they are holding their own, and I'm very happy with that. Jason, is there a personality type you find amongst successful traders, or one that doesn't tend to do well? For example, are our traders extremely competitive? Again, this is a difficult one. So I've been interviewing traders again recently. I was interviewing traders again at the last place I worked. We used to do psychometric testing. We did verbal reasoning. We did maths testing. We did 2 interviews, panel interviews. We wanted them to think on the spot. We tried to push them a bit and test their composure. So all of these things have an effect. I think it would be easy to spot somebody who wouldn't make a good trader and stream people off that wouldn't be suitable. But amongst those that have these core skills, it's not always easy to say. Some people used to think in the interviews that poker players made good traders. I actually found this not to be the case. It can be that if you've excelled at something like that and you come into trading thinking it's very similar, you can be too blasé or too confident. Generally, if we're interviewing, I'd look for somebody that's got an enthusiasm, that knows what they're talking about, and that they know what the market is doing, or they've read some news stories. If somebody says in an interview in response to an economic question, when do you think the Fed will taper? If they prevaricate and talk around the subject, and waffle without really saying anything, I take that as a negative. Not necessarily because they don't have the information, but because they haven't come to the point or admitted it. And one thing I do look for is quickness of thinking. If somebody has an opinion on the economy, what does that mean? Is it a buying decision, a selling decision? Well, what's the information? What's the decision out of that? Because something you need to be able to do is take information and come to a yes/no decision quite quickly. Shall I act? Shall I not act? If I do act, will I buy? Will I sell? What am I going to do? Rather than analyze it and wait and let the trade go by. What resources would you recommend to learn how to scalp? It's a tricky one. Unless you actually have access to the market in this kind of graphical display, this ladder display, was pioneered by TT, and there have been a number of lawsuits on the back of it. But the advantage is that it allows you to see the market depth in a very graphic way, a very visual way, and allows you to almost get a feel. So not only here can I see the depth away from market and maybe imply that somebody's spoofing it with random size, but also I can see other markets. So I've got 2-year here, 5-year here, 10-year here. So what I'm seeing here is a cross-section of the German yield curve. Again, I've got 10-year product for UK here and for the States here, so I can see, okay, the Bund looks to be outperforming the gilts here at the moment. Why is the European curve flattening here, whilst the UK curve and the US are remaining pretty much unchanged? So it's just a case of watching. And some things you can actually articulate and spot. Other things just become hunches. By sitting there in front of those screens, putting in those hours, you do get a lot of information. And it's actually something that new guys find quite painful. I mean, you might be looking at it now, that looks quite interesting. If you've looked at it for 10 hours all day, you're probably seeing those same numbers in your sleep at night. What's my opinion on the Bund as far as scalping? I think the Bund used to have a lot more depth than it does now. So you can see here the Bund, we've got 200s. I remember at pre-credit crunch time, the Bund would have thousands up, thousands down on the prices. Again, it is still possible to read it now, but in addition to the drop in liquidity, there are also more algorithms and more computer programs affecting the market, and that can distort things. It makes the moves less clean. It means that when you're seeing somebody flip the price, it's not a person actually feeling real pain who you can game or whose head you can try and get inside. You could be seeing a computer that has no emotions. It's a hard one, but I would say that there are still clues there. So we've got Bund traders here. When it's doing something or somebody's iceberging the price, they pick on it very quickly. They'll see somebody flipping it. They'll see an algo with a familiar pattern. There can even be algos that come in at certain times of the day. So there are still things to be seen. I would say that trading technically versus depth of market and scalping is not necessarily better or worse, but they might just lend themselves to different styles. So if you're technically trading it, technicals, put in your stops, be dispassionate about it, unless something overrules it like a number or an economic event. If you're scalping it, you can just pay lip service to the technicals and choose your appropriate area to be scalping, but then you're very much going on the other markets. Again, you need fast access really to be able to do that. Michael, what sort of trading exercises might I set for new guys on the sim? I do a number. For example, I would ask them to get a position with 2 on after watching the market for 30 minutes in the morning. From then on, they can only clip 4. So that means they can either add to their 2-lot position to make it 6 contracts, long or short, or they can reverse their position. So they could be 2 in the opposite direction. If they were too long, they're now too short. But they have to have a position all day. And this means you must constantly be watching the market, watching it, evaluating it. You cannot be out of the market at any time. And this is good because it actually forces them to focus on the ladders. Whereas often I will get guys looking at their chart, staring at their chart. It's almost like you have to go over, grab their head and actually physically turn it to look at ladders. Sometimes I even turn off their technical software, remove their charts just to make them focus. I think it's one of those things that is alien at first and it's hard to understand and it is a bit of a chore, but there's a lot of value there. FTSE 100, is that the bid ask? You can see here bids are the blue, the offers are the yellow, so this is bid ask spread here. So you can see it's a 1-tick bid ask spread in all these markets. So these are going directly to the futures exchanges. There is no intermediary. It's not OTC with a spread betting or retail outlet. Yeah, it's just a one-tick spread, the bid offer spread. Lenny, iceberg orders. You can't see iceberg orders. No, you can't see iceberg orders. But one of the things you would see is that somebody takes the whole price and someone puts an order on for 75. Someone takes the whole price again, someone puts another order on for 75. So often it's when the market becomes thin and the price is choice, so there's a battle at a price, and you can see it. Sometimes it's very clear, other times it's less clear, and you need experience to see it. And when people use iceberg, it can be a loosely applied term. So it could be that somebody's got a machine that's clipping 75, 75, 75, and they're doing a volume-weighted average price or something. It could be that you've got a manual trader here, a point-and-click trader such as myself. I want to do some size, but I don't want to spoof or scare the market. So somebody will take it, and I'll just put in 10. They'll take that, maybe I'll put in 7. They'll take that, I'll put in 12. So I'm not iceberging per se, but I'm just working a price. Again, there can be a thing where you have auto spreaders. So if I've got an auto spreader and I need to do, I don't know, 50 oil spreads or butterflies, I'm not actually legging it, but I've got an auto spreader set to a reload size of 10, so that if I get legged, I'm not overly exposed. So it will do 10, 10, 10, and only if it gets off each previous clip on the multi-legs will it continue. Okay, one more question. Overnights. It depends on the style of trading. So a couple of people about overnight positions. When I'm trading bonds, I wouldn't have overnight positions. If I was trading equities, scalping, day trading, I wouldn't have overnight positions. The guy who trade the Euribor, the short end, so these ladders you moment, generally wouldn't have overnight positions, but when it comes up to contract roll, they will build positions into expiry if they can see where LIBOR is heading. The LIBOR fixings on a daily basis are edging one way or the other, so they will build positions in that way. That being said, when I scalped gilts, which I did for a number of years, my trades would last, I mean, literally seconds. No joking aside, seconds. To hold a trade for 10 minutes would feel like an eternity. That being said, when I traded oil, I could have positions for as long as 4 months, so a complete contrast. In fact, for me to get in and out of a single position in oil on the same day, I think only happened once or twice in the 2 years I was trading it previously. Okay, guys. Well, thank you very much. It's been a pleasure talking to you, Tom. Thank you very much, mate. Cheers for the opportunity. I hope it was all of use.
Okay, fantastic. You should be able to see my MetaTrader. Not that you need to, because I'm not going to talk about anything else tonight. I think that was a fantastic presentation. Really like to thank you for coming on and taking the time to do that, Piers. And like I said at the beginning, it's great to hear from somebody else that is not only a professional trader but also has experience with studying other professionals on a day-to-day basis, people that are striving to become profitable traders. What I found really interesting is a point that I've said before from my experience in prop, which was that you saw the kind of discrepancy between people on sim and then people that moved to live. And I certainly remember from the early days at Futex, when I came in a group, and you'd sit there and you would be able to churn out consistent profit on sim, where you had no pressure at all. You knew that you couldn't lose any real money, and you could just do your thing and stay pretty level-headed. You really didn't care. You weren't attached to the returns, as it were. And then as soon as you go live, there was like, right, this is it. You're live. This is suddenly real. And I think there were, almost without exception, nobody, certainly in the first few days and weeks that they went live, returned any kind of performance anywhere near what they managed on the sim. I think it's a worthwhile exercise to certainly start out on the sim. I know that nearly all prop firms that you're going to encounter are going to put you on sim initially to start out with, especially if you're learning. Even if you go in with a record. I mean, when I started at Futex, I went in with a record and they put me straight on sim initially. So, you do go on sim to kind of prove that what you can do works in terms of an edge. But I always say to people, I think that as soon as you feel ready, it's better to get cracking. And test yourself, because you don't want to be someone that repeatedly performs on sim but can't translate it into live profits, and you won't know that until you actually have some money on the line. The advantage of a lot of brokers out there nowadays, you can trade mini lots and micro lots and all the rest of it, and this just gets you feeling that there's a little bit of P&L moving from a psychological perspective. Just to quickly add something to the MOCs, I know at Futex the guys there are pretty big on MOCs. It was as Piers was saying, it can either be a fantastic end to the day or it can be an outright disaster. There's a lot of volatility. I know that from watching one trader that used to trade the MOCs and the FTSE, and he was looking for traders that were caught into the market closing and basically needed to get out of a position. So he'd essentially be looking for the market to be going one way and someone to either be paying up or paying down, and then he'd try and get in front of them. I think it's what he was doing at the time. It's not something I do, but it just goes to show you how many different ways there are to do things. And what Piers said tonight about trading one market or a very small number of markets is something that I mentioned much earlier on in February this year, because I really do believe that people can get profitable quicker by slimming down the number of markets they trade. If you're trading 10 markets, it's not so hard from a technical perspective. If you've got to monitor 10 support resistance levels, 10 trend lines, etc., it's not that hard. But the problem is to know the nuances of the market, the intricacies of the market, and pick up the little things that you get to spot is quite difficult. When I say little things that you get to spot, I'm talking about, for example, the thing that we saw early on this year happening quite often about the bunds moving up ahead of the ECB, which I called the Giacomo effect. But also things like gold moving ahead of interest rate statements recently. Little things like that you're much more likely to spot. If you were just watching gold or just watching bunds, you're on top of those things, where if you've got 10 markets, it's really hard to see those things happening in as much detail. And obviously one of the things I found is that people have bread and butter trades, but a lot of the big money that's been made by guys certainly that I used to work with was capitalizing on things that maybe here today, gone tomorrow. Very short-term patterns. I remember a lot of guys at Futex absolutely killed it when Jerome Kerviel was caught in the financial crisis. He was trying to hold the market, and basically the market was going against him and he was getting caught. And I know that a few guys were spotting things in the order book and basically capitalizing that. And that's not a pattern that's going to be there every single day, but these guys are very sharp. They see it happening and they really press their edge. So there's something else to think about. Not every pattern is going to be here and last for 6 months, 6 years, 10 years, etc. It may be something that appears for a week and you never see it again. But if you're watching a few markets, you've really got your eye on the ball, then you can spot these things. It's certainly easier to spot them. Anyway, I'm going to call it a day there. So finally, just like to once again thank Piers. A fantastic presentation, Piers. Really enjoyed it, and hopefully we can get you back again soon, Piers.